My name is Justin, CEO of Calyx CPA. Today, I want to spend some time explaining 280E exposure in the psychedelic industry. This is one of the most common questions I receive. I recently did a webinar for the Healing Advocacy Fund and participated in a panel where we discussed similar issues. You may be able to access that recording if you want a broader range of viewpoints. When we talk about 280E exposure, the question usually comes down to whether you look at the situation through a conservative lens or a more realistic one. Just because someone technically meets the definition of trafficking under the tax code does not mean the federal government is likely to target them. In the early days of cannabis, federal agencies actively tried to shut down state-regulated programs. They raided plant-touching businesses and attempted to enforce federal drug policy. That period did not last long. Congress eventually defunded the agencies from spending money on enforcement efforts against cannabis businesses in compliant states. There has been some back and forth over time, but federal enforcement is essentially non-existent today because cannabis is too widespread. The cat is out of the bag. Because of that history, people worry the same thing will happen in psychedelics. Could the DEA or other agencies come after facilitators, growers, or service centers in state-regulated psilocybin programs? In theory, they could. These programs are transparent and the state knows where the product is located. In practice, I believe it is unlikely. The financial scale of the industry does not justify federal enforcement. We are not talking about dispensaries making $1 million a month. A psilocybin session might bring in a couple $100 and perhaps $1,000 a day if you are busy. The amount of product involved is also minimal. It is not worth flying a federal team across the country to seize a handful of grams. Where enforcement has occurred in Oregon, it has been tied to unrelated issues, such as employees with outstanding warrants. In those cases, the agencies destroyed the businesses while they were on site. The same was true for the hemp raids conducted by Homeland Security. One bad actor in another state triggered a sweep in Oregon. They tested plants, found them slightly above 0.3% THC, seized land from people who were not even part of the original operation, and then sold the properties back at a steep discount. That was profiteering by the agency, not targeted drug enforcement. None of that resembles what is happening in Oregon psilocybin. The closest parallel would be mushroom growers, because possession of larger quantities might create meaningful criminal exposure. Facilitators who possess only small amounts for sessions have significantly lower risk, although it may still be worthwhile to consult a defense attorney who understands state-regulated psychedelic programs. Once you understand the enforcement landscape, the next question is, who is exposed to 280E? Section 280E disallows deductions for businesses that traffic in Schedule 1 or Schedule 2 substances. The cost of the product itself is deductible, but overhead is not. Overhead includes payroll, rent, office expenses, computers, mileage, utilities, and other basic operating costs. If the IRS audits you and determines that you are trafficking, those expenses can be disallowed. Trafficking has been defined by the tax courts as buying and selling a Schedule 1 or Schedule 2 substance or participating in its manufacture or distribution. That includes growers, wholesalers, service centers, and anyone who takes possession of the product. Testing labs generally do not take possession, so they are not considered traffickers. Facilitators in Oregon are not considered traffickers because they are not allowed to take possession of psilocybin. The service center is the one administering the medicine. Colorado is different. Therapists and psychologists can operate micro tier healing centers and maintain a safe with psilocybin in their office. In that situation, they are taking possession and would be exposed to 2 to 80E. There is an important tax precedent from a nonprofit called California Helping Alleviate Medical Problems. They sold cannabis and were audited. They lost their 501c3 status and went bankrupt. However, on appeal, they successfully argued that their caregiving services were separate from their cannabis sales. The court allowed deductions related to the caregiving activities, but not the cannabis activities. This case establishes that a business offering both services and medicine can allocate expenses between the two. It also makes clear that a 501c3 cannot sell Schedule I substances unless it is functioning as a church, which operates under a different legal framework. For service providers, this means you can deduct a large portion of your expenses if you can clearly separate your service revenue from your product revenue. In practical terms, facilitators or micro tier operators should track two numbers. First, the amount earned from services. Second, the amount earned from selling mushrooms. We then allocate overhead proportionally. Only the small portion related to product sales becomes non-deductible. The rest remains deductible. This greatly reduces the impact of 280E. In many situations, the non-deductible portion is so small that it is hardly worth worrying about, although you should still disclose the activity on your return. Reasonableness is part of generally accepted accounting principles. If the level of overhead attributable to the product activity is negligible, then the allocation itself must also be reasonable. The IRS is not likely to challenge a well-documented and reasonable methodology. I will stop here for now. I hope this overview raises new questions and helps you better understand both the practical risks and the available tax strategies. My goal is to explain how you can do this work, serve your clients, and remain compliant with a low risk and low impact approach. Please feel free to comment or follow up with additional questions.